Hi Jackie, you're welcome. So welcome class for today's session. And today we are going yesterday we covered a number of price patterns, and you're going to build up on that to do other price action patterns. Remember we said in our analysis, we're going to focus more on price action. Will be our main focus, not so much of indicators, although I will also take you through briefly about several indicators just for your knowledge, but also in case you want to try other strategies. I'll also just tell you how some indicators work. But our analysis will be focused more on price action. What is the price telling us? When you open your price chart and you look at it, what are you seeing? Which pattern are you seeing, and what is that pattern telling you? Okay. And also after you draw various tools, when you use various tools which you have to analyze price action, what is the market telling you, or what decisions can you make from the market at that time? So today we are doing Womis and Mullers. And Womis and Mullers are just advanced version of double bottom and double top. They are a little bit more advanced, a little bit more, they have some more precision, okay, in helping you to make a decision. All right, so we want to go deeper and see what are the Mullers and Womis. So Womis and Mullers occur on any time frame, okay, just like the other price patterns. With all those price patterns we've studied, they appear in all time frames. You go to 1 minute, you can identify them. 5 minutes, 15 minutes, 1 hour, 4 hours, daily charts, weekly charts, and monthly charts. They appear on all time frames. Okay. So the same case with Womis and Mullers, and that's why we say this strategy you can use it on any time frame. You only need to find out which one am I comfortable with, given on the time I have or given on my screen time. So which time frame can work best for me? Otherwise, this strategy you're going to learn here it can apply in all the time frames. Okay, so they appear in all time frames and in any market. By that it means in forex market, in futures market, and in indices, right? So that's basically what it means when it talks about in any market. So these catalysts are similar to most of other price action trading patterns. Womis and Mullers are unique versions of the double bottom and double top formations, respectively. So Womis are double bottoms and Mullers are double tops. They're unique versions of those particular patterns which we covered yesterday. So Womis and Mullers also fit into the general category of reversal patterns. All right. So we will incorporate these 7 market truths when we look at trading Womis and Mullers. If the market touches a zone twice in succession, it will often move away from the zone. Okay, what you say, like Womis, we said Womis is a unique version of a double bottom. And we say that double bottom is where the market touches support twice. It forms a W form of a shape. So it touches the support twice, and then it's a signal the market is going to reverse. So you are saying that's one of the characteristics. If the market touches a zone twice in succession, it will often move away from the zone. 2 touches on a zone from above suggest a market bottom. 2 touches which gives us a double bottom. But when the market makes higher lows, it will often continue upward, right? Remember, we said one of the main characteristic of an uptrending market is higher lows, okay? Higher highs and higher lows. So here we are focusing on the lows. So we are saying when the market makes higher lows, it will often continue moving up. Okay? So all these points, they are trying to actually show us slowly by slowly the difference of Womis and double bottom, and how this one, it gives us a clearer confirmation, a more or less precise confirmation that the market is reversing. Okay, and you're going to see further how does it tell us, how does it communicate to us that way. Okay, so 2 touches on a zone from below suggest a market top. That's a double top. So when the market makes lower highs, it will often continue downward. Remember, we said the main characteristic of a downtrend market is lower highs. Okay, so anytime you see a market maker and a lower high, it tells you the market is going downwards, right? So a bullish candlestick on a support zone suggests the market will trade higher. A bullish candlestick, remember the support is where the bears are unable to penetrate through. So if there is that struggle at support and then we see a good bullish candlestick at support, it tells us the market is likely to move in a upward trend or in a bullish direction. So the market will trade higher. And a bearish candlestick on a resistance zone suggests the market will trade lower. So Gomez and Mullers are based on these market observations. Right? Hope you got it clear. But as we go deeper, all these points will start becoming clearer why they have been brought here about the higher lows and the lower highs, and how that works in our favor when it comes to Gomez and Mullers. So we go deeper and look at how to trade Gomez. And we said Gomez, just like the standard double bottom, the Gomez formation includes 2 touches on the zone, suggesting the market finds support on the zone, right? So Gomez matches double bottom. So it also touches the bottom twice, that support twice, okay? So the market will drift higher between the first touch on the zone and the second touch on the zone. Remember we said that for a double bottom, the market touches support twice, all right? It can actually be on the same line. Double bottom touches the support twice. But how Gomez differs from the double bottom, the second touch is higher than the first touch, okay? We said support, there are support zones and resistance. It's just not just a line telling us this is line of support and line of resistance, but it's a zone to mean there's a range of pips. So if the first bottom will touch, then the market bounces, it comes back to support, but the second touch is slightly higher than the first touch. And already this remember, for it to be turning up, the market has been bearish. It has been coming down. Then it finds support, touches support and bounces back. Then a second time as it comes back, we expect the market to make now it has made a low. We are expecting it to make a lower low because it has been downtrending, okay? A downtrending market makes lower lows. Every low is lower than the previous low. But in this case, after it has touched that support, and then it bounces, and we expect it to make a lower low. Actually, it makes a higher low. It makes a higher low than the first one. So already it tells us the market has already breached the characteristics of a downtrending market. We were expecting a lower low, but the market has made a higher low. It has turned higher than the previous. So it has made double bottom, but the second bottom is slightly higher than the first bottom, the first touch, okay? Which gives us a more confirmation. The market is now turning to become an uptrending market. The market is actually reversing, right? Hope you get it. So a Gomez formation is identified by a second touch that is higher than the first touch on the zone, all right? So in this case, when you're expecting a lower low because the market has been downtrending, instead it makes a higher low. It turns a little bit higher than the previous bottom. Already now we start seeing the characteristics of an uptrending market coming into play. And that gives us a better confirmation for sure the market is likely to reverse. Our probability of the market reversing and going upwards, they are higher in such a scenario than where the double bottoms are on the same line, okay? So where we have a case of a double bottom, but the second one is higher than the first one, already it is showing the market is already starting to adapt the characteristics of an uptrending market. So it tells us that it's actually turning from a downtrending market to an uptrending market, all right? So in other words, a WOMI is defined by a higher low. Okay, just what you said there, because the market has been downtrending, making lower lows. But now when it has reached the bottom, it made a low. When you expect another lower low, instead it makes a higher low. Yeah, making a second bottom which is higher than the previous one. So it becomes an advanced double bottom. All right, which gives us a confirmation the market is now reversing, is now aligning itself with an uptrending market. All right, so now we can comfortably enter a buy trade. So recall that a higher low is one way to determine if the market is in an uptrend. All right, this was one of the 7 truths. You know, the 7 truths we've read there. So those truths are meant to prepare us to know how this one matches, or it actually advances the double bottoms and the double tops more. All right. So this subtle difference between a WOMI and a standard double bottom may seem insignificant, but this is a critical characteristic of the market's turning points. Right? When it starts breaching, if it has been downtrending, and then it starts incorporating characteristics of an uptrending market, now we can notice the market is planning to, it's reversing. So when we see that, we look for a signal candle, a signal to confirm to us, yes, this market is turning, I need to enter a buy trade. Okay, great. So the stop loss for the WOMI trade is placed below the low of the first touch. That I will illustrate to you just now. Hope you got the differences. So we are saying a WOMI is an advanced version of a double bottom. The only difference, the second bottom is slightly higher than the first one, which actually gives us a higher probability of our expectation of a bullish market playing out than a case where we just have a normal or a standard double bottom where the two bottoms the two peaks at the bottom are on the same line. Okay, and we have a case here, we have an illustration there of a WOMI, right? So as you can see, there we have a double bottom. And the first bottom, it touches the line of support. It fully touches the line of support around here. Okay, you can see here, this is our first bottom. It's in line with support. All right, that's our support line. So it touches the support line. But the second bottom, you can see the market, the candle closed a few pips away from the support line. You see, a candle closed about here. Okay, so it's a double bottom, but the second bottom is slightly higher than the previous one. Remember, this market has been downtrending. So this was let's say this was our L3. Okay, because in a downtrending market, the lows get lower. So we are expecting our L4 to be here, as if the market is to continue to be downtrending because lows get lower. But now this low, our L4 appears around here. All right, it has now occurred here, and the market has given us a signal to, like, it's actually reversing. Okay, so we know now this low, it's higher than the previous low, and already this is a characteristic of an uptrending market, because uptrending market, the lows get higher as the highs get higher. Okay, so when we see it reversing here, already we saw there's a line of support here, so we wait for the market to see how is it going to behave in this support. Will it break? Because again we say it's at the support zones and the resistance zones where decisions are made. Okay, so once the market comes down, forms a L3, that's our low there, and it retraces. We expect the market to go down, break this support, and make an L4, which is lower than L3. But instead, the market does not break support. So here we'll be watching and see, will the market break support? What is it? How is it going to behave? All right. Then we see a candle comes, it's rejected. Then I will look at the second candle. How is it going to behave? And then we notice a bullish candle is forming. Okay. So this candle means a lot. Again, we said about the tips of trading. Tips of trading warmest and mullahs. When a bullish candlestick appears at support, then that tells us the market is moving upwards. The market is bullish. All right. So here we have that this bullish candle here will be our confirmation candle. All right. So the market has come, made the first bottom, retraces, comes back again, and now we are watching how is it going to behave here, because decisions are made at support and resistance zones. Then we see this bearish candlestick. There is some rejection. Yeah. When the tail is so long, it tells us the price has been rejected. Okay. So we look at, so let's wait and see if we are going to get a signal candle for us to enter. All right. A signal candle. Then we see a bullish candle forming. All right. And then again, we know when a good bullish candle is forming at an area of support, it tells us the market is moving up. All right. So we wait until this bullish candle gets it closes. Just remember a question Carol asked. Was it the first day or the second day when we began the candlestick analysis? The question was, when you see the bullish candlestick candle starting, do you enter your trade as it starts or after it closes? So because this is our signal candle, you have to wait for it to close. That candle, even if it goes how long, wait for it to close, because anything can happen. Even the last 2 seconds, yeah, that candle can actually start as a bullish candle, but the last 5 seconds, guys come in and push it down, all right? And then it closes as a bearish candle. So when we see now, we've already seen there is something happening here. It already communicates to us something. Then we wait for a signal candle, which is now the bullish candle. So when the body is so long, you can see the body of the bullish candlestick, it's almost equal to the body of the bearish candlestick. So we wait. Once it closes, we immediately enter our trade. Okay. So in such a scenario, what you're going to do, if after this candlestick closes, at the bullish candlestick, it has not confirmed to us this is a warming and I can comfortably trade it. So after it closes, we enter our buy trade there. We buy. Okay. So once we buy here, we place our TP somewhere here, just below the bottom of the first bottom, the bottom of the first bottom of our warming. Okay. So that will be our entry. That's our entry. It's a buy entry. That's our SL. Okay, SL. All right. So after you've done our analysis, with our TP wherever, somewhere up there, we'll also come and see how we decide where to place our TP. Okay. So after this bullish candlestick closes, we trigger an entry. We buy. All right. After we buy, we put our SL just below the previous bottom, and then our take profit, we'll see where we place it in our next analysis. Then once the market moves, right, the market moves in our favor and it crosses. Remember here there's a line of support, all right? Sorry, it's a resistance, line of resistance here. You can see there's a lot of resistance here, okay? This was our previous high. The market came, it made a lower high, and then it came down, could not make a lower low, then it bounced. So the market crosses that resistance, all right? The arrow facing up, it's showing our price movement. Then we will move our SL from here to somewhere here, all right? Once the market crosses this resistance, or when it's just around resistance, we move ourselves to break even, all right? So that we lock our profits, because the market can also reverse around there. So now we call it a trailing stop. Now we are trailing our market, all right? So we move up to break even. Break even to mean that it's just plus a few pips, so that in case it reverses, we don't lose everything. We still get some profit, all right? And then as the market moves, we continue trailing it. And you're going to see how do we continue trailing as the market moves up. So that's how you trade a WOMI, all right? So you wait for confirmation of a double bottom. Once it shows a double bottom is happening, and then it will get a signal, which is the bullish candlestick, just after, slightly above the support line. Once that candle closes, you can now buy. Then put your SL before the previous bottom, and then you take profit. How do you determine the break-even point? Oh, break-even point is you just place it above, anywhere above your buying price. Anywhere. But we still look at, like in this case, we bought here. That's our buy entry. Okay. We buy here, all right? And then our sell is here. And then the market has moved. After we bought, the market has moved. And now the market is here. Again, we are made at the support zone and resistance zone, all right? And you already know from there, when you look at the left of the price or of our current price, there's a lot of resistance here. So we know this market can also fail through resistance. They can reverse and sorry, just a second. Okay, so we are saying here there's this is a resistance zone, and anything can happen here. The market can rise up, hit there, and then reverse all the way and come and take us out at a loss where our sell is. So the moment our market gets to here, all right, it has moved from here, and now it's at this area of resistance where decisions are made. At this level, because our entry is here, we bought here, and our sell is somewhere here. So we are going to move. If this price is, let's assume it's USDCAD. So the price is we bought at 1.2000, okay, and our sell is at 1.1980, okay, and the market now is at 1.2100, okay. So we are saying we will move up our SL to buying price plus a few pips, okay. So in this case, we still want to give the market time to breathe, all right. So you will not move your SL so close. You cannot just come somewhere here. It can be knocked anytime, and there's nothing as painful as being knocked, yeah, and then the market continues going in your favor. Sometimes it runs like it knows what it has done, all right. Like in this case, just imagine if you are removed here, yeah, and then you can see the next bullish candles, how strong they are. Sometimes you can feel like crying. You're like, why did I do that? How could I make such a mistake? I'd enter such a nice trade, then you leave with 80 points or 20 pips, yet you had a chance to even pocket almost 100 points, right? So we are saying we bought here at 1.2000. The market has moved. It's now at 1.2100. So what we'll do, we'll move our SL to just somewhere here. Let's say 1.2050, okay? Such that the market still has room to breathe, all right, to struggle, because here there has to be a struggle. There is resistance. The market has to struggle until the bulls break out, okay? Because again, when we come too close, we will struggle our trade. And then we might be knocked out only for the market to raise in our favor. And that time you've already been thrown out of the market. So you just try to, it's called protecting your trade. Just a few pips, the buying price plus a few pips, just to be on the safe side in case the market reverses. All right. So there's no really clear formula on where you place your break even. You just use you see how the market is behaving, where it is, then you just lock a few profits to ensure you're safe. You protected your trade. You'd rather be there so that when the market moves against you, at least you have something to show. If the market now reverses here and it starts moving down, you'll not be hit at your stop loss, okay? You still get something, you not come out of the market with nothing. Great, great, great. All right, so that's how you trade a WOMI. And the same case with the Mula. So you imagine this is just inverted. So it will be a double top, and you enter your trade the same way. Okay. So how to trade Mulas? And the Mula it's simply a double top on an important support and resistance zone, right? The Mula trade is a simple but powerful trade. The rules are simply the same as for the WOMI trade, but reversed for double tops, just what we've said there. You apply the same rules, but in a reverse direction, because it's now a double top as opposed to a double bottom. So tips for WOMIs and Mulas. It may be tempting to take every WOMI and Mula that appears on your charts, but it's important to note that some WOMIs and Mulas are better than others. So if you want to pick only the very best WOMIs and Mulas, try to do the following. So you choose the setups with many candlesticks between the touches. Yeah, I think we mentioned all that yesterday under the double tops and double bottoms. So the more effective ones, it's where we have many candles in between the first top or the first bottom and the second one. That's between the touches, okay? 6 candlesticks between touches is nice to say, but 20 candlesticks between touches is better. So the more candlesticks are between the touches, the more chances that the market will play out in our favor, right? Because you can see there is a struggle. So eventually the opposing team is like to give up and the market reverses, all right? So the more candles, the better in between the touches. So take trades with catalysts on the second touch. If the second touch is a big shadow or a kangaroo tail, the odds are probably strongly in your favor, right? So we are saying you will notice it's a double bottom, and the second bottom is slightly higher than the previous one. And also, where there is that second bottom which is higher, there is another pattern. There was a question here yesterday whether we can have two patterns at the same zone, and that question is, we said it happens, and this is a scenario where such a pattern, an issue, happening can occur, right? Where we have two patterns appear, which gives us a stronger confirmation that this market is going to behave as per our expectation. So we are saying on that second touch, if there is another catalyst like a kangaroo tail or a big shadow, now it gives us more confidence that this market is likely to play out in our favor, all right? So pick trades that have a second touch much further from the zone. That means either a low which is higher than the previous low or a high which is lower than the previous high, much further from the zone. Only choose WOMIs and Mulas that are in strong, well-defined zones. Zone, remember, we mean by zone, we mean resistance zone and support zones. If the zone is not an important one, then the market may only trade away from the zone briefly before breaking beyond the zone. Remember, we said support and resistance, they are not permanent. Support and resistance, they are not permanent. They can always be broken, yeah? But when one is broken, becomes the other one, all right? So find setups that have very few zones nearby. This will enable you to place a profit target very far from the entry price and maximize profits, all right? Well, for us, every number of points matters. So you don't always feel like I leave because it has 20 points off it. No. It makes sense. Take that trade as long as there's at least your risk-reward ratio. We look at the risk-reward ratio. As long as my risk-reward ratio is better than 1.1, ending 1 is to 2 and above, it's something worth taking. All right. So you look at the risk-reward ratio, and you're going to look at what that means. The risk-reward ratio. Right, that is the guideline on a better trades and the trades which you should just let them go. So trade those who are miss and mullahs that have room to the left. So major reversals often occur at places on the chart with very little price action to the left of the trade setup. So we are saying, because remember we do our analysis based on the price action to the left of where the price is. Because we look at what has been happening, because the candles which have already been formed are the ones we use to identify the patterns and make our decisions. So if you check through the left, there is a big space which there has not been business for some time. It means the market has moved for a long time. If it is a downtrending market, we say the market has been oversold, right? Then there is likely to be reversal. And if the market has been going up, and when you look to the left, there is a lot of space. It means the market has been overbought and is likely to reverse. Okay, that's what it means by more room to the left. But you're gonna see in details. We briefly soon we're just going to see in the platforms how to identify such, and you see what room to the left means. Then we have another price pattern called kangaroo tail, right? And you see a kangaroo tail is a distinct price pattern. A kangaroo tails may print buy signals, that is a bullish kangaroo tails, or bearish kangaroo tails, which are sell signals. The kangaroo tail has two parts, the kangaroo body and the kangaroo tail. So all kangaroo tails are single candlestick formations. Remember, the other patterns we've been covering, it's a series of candlesticks which give us the pattern. But for kangaroo tail, the pattern is only, or the signal is only formed by one candle. Okay, so it's a single candlestick formation. Ideally, the kangaroo tail is much longer than the body of the kangaroo. The tail is longer. The tail is what we are calling the wick. Okay, the tail is longer than the body of the kangaroo itself. So the best kangaroo tails have very long tails. The long tail suggests that the market has extended too far into a zone and is likely to reverse. Actually, I've seen this often with gold. It's like the market just gets excited. It prints a very long candle only for the price to be rejected and closes further away from the high or the low of the candlestick. That has been very often with gold. So anytime I see such a tail in gold, I'm not sure this market like to reverse. Yeah, it may not be a total reversal, but likely to retrace so deep that retracement can give you an opportunity to make some profits. All right. So there are other characteristics unique to the kangaroo tail, and all kangaroo tails must maintain all these characteristics. So we are going to look at these characteristics, and you're saying we look at the open and the close. Yeah, we remember what we looked at, the open and closing of the candlestick. So all kangaroo tails have an open and close near the extreme end of the candlestick. Near the extreme end of the candlestick. Remember, we said in between the opening and the close, that is the body of the candlestick. Between the open and close, that's the body of the candlestick. And you have said one of the key characteristics of a kangaroo tail is the tail is very long, longer than the body itself. Okay, so it means the open and close will be so much closer to the extreme end of the candlestick. The rest of the candlestick is a tail, but the body is so small at the extreme end of the candlestick. Okay, you see the body is the part in between the opening price and the closing price. Okay, so it's at the extreme end of the candlestick. The rest, it's a tail or the wick. So for bearish kangaroo tails, that is the sell signals, the open and close of the candlestick should be in the bottom third of the candlestick. Okay, just elaboration of the first point. So there is a similar rule for bullish kangaroo tails. The buy signals must have the open end, the close in the top third of the candlestick. Again, the signals of kangaroo tails are long. So most kangaroo tails are longer candles, as the candle itself is very long. So this means that the kangaroo tail will be a bit longer than the surrounding candlesticks. Longer kangaroo tails have a tiny body and a long tail. So the best kangaroo tails will have very long tails and very short bodies. Okay? The kangaroo tail with a very long tail suggests the market has become extremely excited before reversing sharply. So a kangaroo tail on a zone is a high probability reversal candle at a spot on the chart where the market has historically reversed time and time again. So we are saying when these kangaroo candlesticks appear on a zone, that is a support zone or a resistance zone, chances are the market is reversing. So they will make more sense and we can take a trade. Okay, then kangaroo tail placement. How do we trade kangaroo tails? So kangaroo tails should be near, sorry, not spread, but where you are like to find them. Kangaroo tails should be near the previous candle. If a kangaroo tail is too far from recent price action, it may suggest a runaway market, suggesting the market is not ready to reverse. So one way to quantify whether a kangaroo tail is near recent price action is to look at the open and close relative to the nearest candle. If the open and close of the kangaroo tail are inside the range of the previous candlestick, the kangaroo tail is valid. We are saying you look at the previous candlestick, you look at its open and its close, that is the body. Then you look at the kangaroo tail which has been formed. Its body should be within the range, should be actually like it can be swallowed. It is shadowed by the previous candlestick. All right, hope you get that. Then we have the kangaroo tail tips. There are several optimizers associated with the kangaroo tail trade. If you have the patience to wait for only the very best kangaroo tails, watch for the following characteristics. We look for kangaroo tails with a very long tails, kangaroo tails with much room to the left. So the ideal kangaroo tails will print at an area on the chart that has not seen price action in a long time. Yeah, we are saying we look at the left and there is enough open space, which tells us the market has really moved. It has not been in this area for a long time, so it's likely to reverse, right? So then you also look for bullish kangaroo tails with a closing price that is higher than the opening price. What it means, if it's a bullish kangaroo tail, it's not just it has a tail at the bottom. Also, the body closes as a bullish candlestick, and we are saying that it's confirmed when the closing price is slightly above the opening price, because it means when the candlestick opened, it traded higher, it traded lower, formed a very low low, then it started moving up. They both started moving the candlestick up, forming a very long tail, and then eventually it closed slightly above the opening price, such that the resultant body is a bullish body of a candlestick. Okay, and the same case applies to the bearish ones. So we are saying the candlestick after the bullish kangaroo tail trades higher than the high of the kangaroo tail, and the candlestick of the bearish kangaroo tail trades lower than the low of the kangaroo tail. We look at these things on the platform for you to just internalize them. You see kangaroo tails that trigger the buy stop or sell stop entry on the first candlestick after the kangaroo tail. So we are saying once it has formed, then you can now place your pending order on whichever side. So if the first candlestick after the kangaroo tail, is triggered, that's almost a confirmation that your trade it's going to play out as expected. All right. So we look at an example of a kangaroo tail. although this, but you can see this one, it's a very long tail and a very small body, where that arrow is. You can see that. Very long tail and a small body, a very top cross. That's a kangaroo tail. Although this one where it has appeared is not more of a reversal but a continuation. It's also confirming to you that the price is going to move up, up, and up, because you can see there are so many candles here. The market was facing resistance, But the moment you see this candle form, you're like, this market is going to move up. And you can see after that, the following bullish candlesticks are very strong, moving the market up. Okay. So when that appears, tells you don't have to move even your stop loss any closer. The stop loss any closer, the market is likely to continue moving in a bullish direction. Okay. So that's an example of a kangaroo tail. All right. So, and this is a bullish one, because the tail is at the bottom. The sellers, the bulls have pushed the market up. Price has been rejected, and they want to make the market up, up, and up. Okay. So we are going to go to our chart and see if we can identify some of those patterns. That is the wormy, the moolah, and the kangaroo tail. So let me just share my screen. You can see my screen, right? Just wait for it to appear on my phone to be sure you can see it. Great, you can see it. So we look for wormies, mullahs, and a kangaroo tail. Just a second, I'm going to see if I can trace one. Actually, this can be part of it. We on the USC H4. Okay, this is a double bottom, right? Just let me draw so that you can see. That's the first bottom. Then we have this one is slightly, okay, this is almost equal. It's almost equal. Let me see if I can get a clearer one. Maybe this one here, although this market is not clear. Just see if I can get another clearer one. Before you look for this, look at there's a kangaroo tail I can actually see. And I told you this is very common in gold. I've seen happen a lot in gold. You can see this. Although it is still closed as a bullish candlestick. Yeah. Let me show you the one I'm talking about. Look at that candlestick, okay? The one I put that red arrow. You can see the tail, eh? The tail is quite long. Although the candlestick closed as a bullish candlestick, as a bearish, sorry, because it has a bearish body. But the tail is so long and the body is so small. If I was actually in the system, I would have bought here. I would have bought. Okay? Look at that rejection. The tail is quite long. Very small body at the extreme top. Okay? At the extreme top. Although the final body is a bearish body, but that level of rejection, that long tail, is I would have comfortably entered this market. Okay? So I'll wait for the candlestick to close and then I will enter my buy here. You buy there and then you put your stop loss just below the tail of the candlestick. Because you're saying if here there are so strong bulls, they may not allow the price to go past this region here. All right. So I will enter my buy entry there and put my SL somewhere there. All right. So you're saying you buy and then your SL. You put your SL there, okay? And you can see after that candlestick form, you can see there the following candles. They are all very strong bullish candlesticks, okay? Which followed after that. Very strong move by the market, okay? So that's an example of a kangaroo tail, and it's a bullish one. The body may not be bullish, but the characteristics of a very long tail and the body being at the extreme end, okay? Are you able to zoom a bit? Oh, let me see. Let me try. Let me try to zoom again and see if it can. You can see now, eh? Where I put that red arrow, that's a kangaroo tail. Okay, that's a kangaroo tail. The body is quite small at the extreme top, with a very long tail. Although there is not a body, it's a bearish candle. It's a bearish body, but based on that rejection from the bottom, and I said this is very common in gold, and actually this is gold. All right. So if I was actually in the system at this time, this happened at what time? At around 2. But then I was just held in my shugulis, But this one I would have comfortably bought. And you see from that the price moved up to here. The candle it closed at 1304. From there the market went up to 1312. That is 70, actually 80 points. 80 points. And with gold, that means a lot. There are some instruments which they can actually a small move can make you more money than the others, like gold and the indices. All right. So 80 points in gold, it's a lot. That means a lot. All right. So, and also it will be achieved in a very short time. This was achieved within 1, 2, 3, 4, within 1 hour. So say within 1 hour, you place your trade, you relax 1 hour, you get your profit, and you can say, hey, I'm done for the day, I can actually go. Yeah. But given how strong those candlesticks are coming, it's an indication the market may still continue moving up. Okay. So that's a kangaroo tail, which you can comfortably trade. Okay. So that I find a little bit more common in gold there. And it can happen with short time frames. These are 15-minute time frame, but you can actually see them in other time frames. Okay. So that's a kangaroo tail. So I will try to minimize it a bit, Jackie. When it's like this, we may not see the pattern, but once I identify, I will zoom it for you to see clearly. Okay, so I just try to do this way for us to be able to see the pattern. Once you see a pattern, I will now zoom it out for you to see. Great. This is another very good opportunity. All right, this is actually a mullah, right? We have a mullah here. You can see this is the first. That's our first top. Our second top. So we are saying when the market is here forming the second top, when the market is actually standing here, and also especially the tails tell a lot. The tails tells you, tell you that there's a lot of rejection there. The price is being rejected, okay? So actually that reminds me, I need to zoom in now that remove this. So you see here we have, this is the first, oh, that one does not pick the way it should. That is our first top, and then we have our second top, okay, here. Okay, so we said what happened when the market makes this high, already it tells there is some resistance here. So you wait for the next move. Is the market going to cross? Okay. If the market does not cross, you see the market approaching and behaving a funny way. Like here, you can see it came up to here, and then it formed a very strong bearish candle. And let's say you're like, now this it's forming a moolah, and then you sell here. Immediately after that, remember we said you actually enter your entry after the closing of the confirmation candle. So here we are watching how the market is going to behave, and then we get this strong bullish candle. Then we, as the other bullish candle starts, we sell. And you can see after that candlestick, even the market gap. And this was actually yesterday at 10 p.m. Let's say you sell, okay, this is the opening of the market. So as we say this, the indices gap a lot. They always gap. Almost on a daily basis. They really gap in the course of the week. That's why I never like to hold a entry. But if you are confident, because you have seen a moolah, and you're saying a moolah gives you a stronger signal to enter the market. So you sell here and you put your top loss here, and you're like, let me take the risk, and I will let the market slip off. Okay? Then the market will have moved from here to, it gaps in your favor, and it becomes this much. Okay. So if you saw, let's say you saw that the opening was 25.57, 575. So let's say you saw that 25.550, 550, and the market came. The low was 25.450. That's 100 points. Yeah, and for indices that means a lot. For indices, those 100 points means a lot. Okay. For Wall Street 30, that means basically almost $100. But if it was SP 500, which behaves, it moves the same way. The same structure the Wall Street is likely to take. The same case with SP 500. Actually, many times I use a different system to do analysis. It's called Ninja Trader. That one you have to buy. So, and I usually use it for, if I want to trade with to trade SP 500, I will analyze Wall Street 30, because that system does not have SP 500. But when the Wall Street 30 gives me a signal to enter, I'll come and buy or sell SP 500 based on their, because they move. If this one gapped, chances are even SP 500 also move gaps, and that's the same case. You can see it actually gapped also last night as it opened today. If Wall Street 30 gaps also, SP 500, it is going to, because they are indices, okay, measure of the movement of stock prices. So if it was like 100 points of SP 500, okay, if it was one lot, because 0.1 would have given you 1,000 shillings, but one lot would have given you $10,000. You know, some of you hear that they want to jump and stop Euro USD, GBP, and go to SP 500. Please don't do that. The same way it moves to make it, the same way it can actually move against you. Oh, sorry, I'm breaking. Sorry. Let me hold it nicely. Sorry, Marianne. Okay. So you see that breaking, that gapping, that gapping. All right. But it was just after it formed a molar. And that when a molar forms or a wome, it's a stronger indication or stronger confirmation that the market is going to behave in your favor. All right. So now we have seen kangaroo tail, we have seen a molar, and a molar is where the second top is lower than previous top. Okay. So we can also see we can actually find a wome. And when you look at where we are right now, look at the current price where we are. This market is actually like forming a wome. That is a double bottom, and the second bottom is higher than the previous one. Okay, so we can say this is our first bottom, and the second bottom is forming here. All right, which is already higher, and also that kind of the tails tell a lot. The tails tell a lot. Okay, so you can see the market is standing slightly above the previous bottom. Yeah, so here you can actually buy, and then you put your stop loss somewhere here. Okay, so you entered your entry here, and then you wait for the market to display. All right, or to take other to play out. That is okay. You wait for the market to play out. Great. So that's it for the womies and mullahs and the kangaroo tail. Unless there's a question, we want to move on to the next topic, which is Fibonacci ratios. If there is no question about the womies and mullahs and the kangaroo tail, we move on to Fibonacci ratios. Oh, I'm okay now, Marianne. Am I still breaking? Can you hear me properly? Sorry, sometimes I'm looking at the chat, I find myself take profit. Now we are getting deeper there now. For now, whatever we've done so far, we've not yet reached up about how to determine your take profits. But where we are going right now I can hear thank you. Jackie, so where we are headed to, we are getting closer to refining how to place all those, how to decide where to place all that, your sell and your take profit. Okay, so far we are just saying place it somewhere there, but we are going to get precisely where do you place your take profit. Okay, and Fibonacci tool is one of the one is going to show us where to place a take profit. We said we combine several. Once you are done with the course, we'll narrow down to combining the Fibonacci ratios, support and resistance, which we'll call it structure, both at the same time. I'm not getting, kindly clarify. Your question was, and when do we place stop loss? Then the second one is both at the same time. Let me get your clarification on the second part of both at the same time. But basically, after you've done your analysis, you make decisions. Before you decide to trade, you must have decided. Yes, those decisions you make them. Before you enter your trade, you must be knowing already, where am I going to place my stop loss? Where am I going to place my take profit? You cannot analyze it, I'm buying here without knowing where you're going to place. You don't decide later. No, it's just that we are not yet where we are. We are not yet at the level where we can actually decide where to place it. As in, I've not yet reached there in my training. Okay, for now, it also is still a little bit blurred when it comes to placing take profit. But as we go deeper, like this next topic we're going to cover, it will start now giving us some clear indication of, yes, exactly, both at the same time. Those three entries, your buy, okay, your order entry, that is either a buy or a sell. At the same time, you must place your take profit and your stop loss. You must do those three at the same. If you're buying, you buy, then you enter your take profit and your stop loss. If you're selling, you sell, all those three must happen at the same time. You don't analyze, decide to buy or to sell, then you wait, decide later where to place your take profit and your stop loss. No. Those three decisions are made at the same time. Before any entry is done, it's entered. Because again, we are talking of risk-reward ratio. Because unless you know where your take profit is, you cannot determine your risk-reward ratio. Okay? So before you enter your trade, you must calculate my risk-reward ratio. Risk-reward ratio means how much risk am I taking, yeah, for this trade, okay? If it is 1:2, it means I'm likely to lose, maybe I will lose, if this trade goes against me, I can actually lose like 5 points. But if it goes in my favor, I can gain 10 points. So you only take trades where the risk-reward ratio is anything more than 1.2 and above. If you're comfortable with the 1:1, fine, but that's a little bit higher risk, okay? But 1:2, 1:3, at times you get 1:5, depending on how you've entered and based on your take profit position. So when you're doing your analysis and you decide I'm going to enter here, already you know. So my take profit will be here and my stop loss will be here. So all those three decisions are made at the same time before you enter your trade. Great. I can see Jackie. Okay, now it seems you have answered you. So that is very good. So we move on to the next topic. Okay, which is, sorry, click the wrong thing. I clicked the wrong thing. So we go to Fibonacci retracements. We are all there. And you're saying, remember we were saying the market takes a breather, all right? If we can recall, uptrending market, it is uptrending because we have higher lows and higher highs, okay? So the market is not just moving up, up, up. It goes, it makes a high, it comes down, makes a low, and goes up again, making a higher high than the previous high. So that low is what we call a retracement. The market is taking a breather, okay? It's like it's trying to gain a momentum, it pushes, makes a higher high. It takes a breather, comes down a bit, okay? Forms a low, then it goes with a lot of force, moves up and makes another higher high than the previous high, okay? So we are saying, actually, those the lows are the retracements. When the market is moving a little bit backwards to gain momentum to move up. That is what we call the retracement. The market is like taking a breather. And that's why even when we enter, we give the market time we give it room to breathe. Room, okay, to breathe without taking us out at a small profit, okay? So we are saying retracement is a correction that occurs. So we call either a correction or a retracement, all right? The market is correcting, okay? And we say a retracement is a correction that occurs during a prevailing trend. It is often regarded as a period of rest before a trend continues on its original direction, okay? So although the market has been moving up, it moves down a bit. So according to it, looks like it's taking a bearish move. But that small bearish move is it's a breather or a rest. Then it resumes the upward move to make the higher high, okay? So it is important to note that at the point where the trend starts changing, the market can either reverse, that is change the direction completely, or just rest and carry on in its original direction. What we aim to do with the Fibonacci tool is to identify when it is a reversal and when it is a retracement. And we only trade retracements as it is in the direction of the trend. You may have heard the expression used, the trend is your friend. And for our method of trading, this is 100%. Remember we said, we always look for opportunity to move with the masses, okay? If the market is uptrending, it means the bulls are in control, so join the bulls. Always buy. If the market is uptrending, always buy. Unless you've seen it's a reverse, then you enter a different trade. But as long as it is uptrending, always look for opportunity to buy. And we said we buy at the low as we aim for the market to move higher and higher. If the market is downtrending, it means the bears are in control. Join the masses. Join the team which is in control. These are the sellers, all right? So we move with the trend. Never trade against the trend, because we say they are going to knock you out. They are stronger than you, all right? So you join the masses, move with them. So the masses are trending upwards, trend with them upwards. It's a downtrending market. Also, look for opportunity to sell, all right? A Fibonacci retracement is a term used in technical analysis that refers to areas of support, that is price tops going lower, or resistance to mean price tops going higher. Fibonacci retracement levels use horizontal lines to indicate areas of support or resistance at the key Fibonacci levels before the trend continues in the original direction. There could be so many words, but don't get confused about all that. You just, at the end of the day, you'll get very clearly what all this means. So these levels are created by drawing a trend line between the high and the low, and then dividing the vertical distance by the key Fibonacci ratios. These Fibonacci ratios, these numbers have a story. They have some mathematical story, which you don't have to go into it, all right? So you only look at the key ratios which we need to use, which are already calibrated in the Fibonacci. You don't have to look where is 23, where do I put the 50? No, they're automatic. You only need to know how to draw the Fibonacci tool, and then the ratios are automatically calibrated on they appear on your screen. So we have 23.6%, 38.2%, 50, 61.8, 78.6, and then 100%. So these are the key ones which we use for retracements. So Fibonacci retracement levels are static prices that do not change, unlike moving averages. A moving average is as an indicator, right? So at the end of our class, although we are focusing on price action, we'll also briefly look at some of the key indicators. I'll tell you how they are used, so that in future you can also feel maybe I'm comfortable with indicators, because we get, again, in Forex, there are so many strategies. There is no one particular strategy. There are so many strategies in Forex, which all of them still do work. There is not one standard one, okay? So we only teach you what we use, what we've seen it work, but maybe you can also feel comfortable with an indicator, you use it, okay? So, but you're saying now Fibonacci is a static, unlike a moving average. And a moving average is an indicator. The static nature of the price levels allows for quick and easy identification. This allows traders and investors to anticipate and react prudently when the price levels are tested. These levels are inflection points where some type of price action is expected, either a rejection or a break, right? And that's an illustration of a Fibonacci ratio, all right? Now, if the market is downtrend, okay, this is like in our case here, this market is downtrending, all right? It's moved from here going down, all right? So when you are drawing a Fibonacci tool, you will pick it, you just click it on your platform, and then you start from the top, the high, you drag it to the low, okay? For a downtrending market, you drag it from up, down. The market is moving from up to down, so you also drag your tool from up to down. If the market is uptrending, okay, the market is moving up, yeah, and this is let's say this is your low, your L1, and this is your H1, So if that's how the market is looking like, it's uptrending market. So your Fibonacci tool, you draw it from down here, going up. And then all these ratios are are generated. We have 23.6, then 38.2, 50%, 61.8, 78.4 should be somewhere here. It can be 78.4 or 76. That one, that figure, some systems use different, but it doesn't matter. As long as it's either 76 or 78, it doesn't matter. All right, but should be somewhere there. Although it's not appearing here, it's also one of the ratios we use. Okay, so for a downtrending market, you drag your tool from up, down. For an uptrending market, you drag your tool from down, up, in the direction of the market, right? So you can see this market, and that ratio between 50 and 61.8, we call it a golden ratio. That's a very important ratio, okay? And when the market reverses at 61.8, when you see a signal, you get a signal at 61.8, chances are the market is going to continue moving as per our expectation, okay? Because based on this market, we say this is maybe our H1 and this is our L1, okay? So our expected, because a downtrending market, our expectation is for the market to, now it has formed after it forms an H2, should form an L2, which is lower than L1, because it is downtrending market. And we say the lows get lower. Lower is lower than the previous low, and the highs get lower. Okay, those are down. So our expectation, once the market retraces, all right, it has retraced from here to here. So, and it is reversed. We've gotten a signal, it is coming down again. So we will enter our entry here, okay, and then the market will come down here. All right. So at this level, our stop loss will be above the 100%. Where you start drawing your Fibonacci, it's always 100%, okay? And it's an area of structure. So that's where will be our stop loss, okay? Our stop loss will be there. Stop loss, okay? And this is our entry. Then our take profit. For now, I'm just doing it arbitrary, but you get to details to know where exactly to place it. Right, you've seen that. So where it is reversing, so these Fibonacci ratios, they help us to form an expectation. Remember, we said we move ahead of the market, okay? So we are saying, you've looked at the market, you've seen the market it has moved from this high, and has moved to this low, okay? And then the market starts moving up. Let's say you come and you find the market around here, all right? So you form an expectation. You decide you can actually enter at that 8 or 50 or 61. So, but many times you look at where there is already structure. Like here we have some support here, So you can actually say, this area looks very strong, so I will only enter once the market gets to 61.8. So as we speak, the market is around here, okay? But you said, I'll wait for the market here. Because again, at this level, it gives me a good risk-reward ratio, all right? Because you are saying, that is the loss I'm willing to take against a profit of, because if it is coming to a L2, which is around here, right? That's our L2. You can see the loss is small compared to the profit expected. And that's what we mean by risk-reward ratio, okay? And our SL is around here, slightly above the 100, or rather the structure. But with time we'll learn what is where. So that's where our SL is. Our TP is here. That's our TP, okay? So we wait for the market. So the market, we've come in when the market is around this level here. So we wait for it. This is my area of interest. I will only enter, I will only sell when the market reaches here and it gives me a signal. Okay? So the market, once it gets to 61, you don't just say it's at 61, I'm going to sell. No. Just reach 61, great. I'm waiting for confirmation that the market is going to continue in a downward trend. Okay? So once you get a signal here, it can be a kangaroo tail or even any of the other patterns. And also the other, we'll also see how we see a rotation candle. Rotation candle can also give you a signal. It is time to market is resuming its original trend. So you trigger your entry. All right. So that is our entry point. This is our take profit. Now, once the market has moved, we enter again. Now the market moves and it reaches here. All right. It's at the same level with the previous L1. Now here, because here is some risk, we expect the market to face support. As you can see, this is a support area. That's the market reversed. So when it reaches here, we expect to face another some support. So the market can still reverse at here. It is not guaranteed it will achieve the L2 or the lower, which is lower than the previous one. But once the price reaches here, now we move our SL to break even from here to somewhere here, which is plus locking a few pips. So our trailing stop, we put it there. Okay, so that just in case, remember this market can come and reverse and then it forms a double bottom. It's actually reversing. So if you just wait here, it means the market will have given you profits, then it takes all your profit away only to knock you out at your stop loss. Okay, so when the market moves, it reaches this area of support, you protect your trade. You move your SL to a trailing stop to ensure just in case this market does not achieve the L2 or a lower low, then I'm safe. My trade is safe. I'm ready for anything. And you're comfortable. If it achieves L2, well and good. If it reverses, well and good. You have not lost anything. Yeah, your trade is protected. You're gonna even take away some points. All right. So that's how we enter. We work with Fibonacci ratios. Okay. Although we have this ratio 23.6, sorry. So we have 23.6. But personally, I don't take trades for 23.6 because the risk-reward ratio is not worth it. Remember, even if you enter here, your stop loss must be here. All right? So look at that risk. Look at that risk. So 23.6, I don't. In fact, when you go to the platform, you realize in my Fibonacci ratio, I've already removed the 23.6. To me, it does not exist. Yeah, because it does not really give me very good risk-reward ratio. Okay, so that is the risk versus whatever we are likely to take here as a profit. So you can never take bigger risk than the expected return of the trade. If that is the scenario, let it go. So even if the market gives me a signal here at 23, I will let it go. I will let it go. Okay? So many times I'll wait until it reaches 38.6 unless there's a good reason. Yeah, maybe the move is so strong, then once in a while I'll break my rules. Once in a while you're okay to break your rules, but also be ready for the risk. So in such a scenario, if I feel there's a good signal at 23.6, then I will reduce my lot size. I will reduce the volume, all right, to ensure it's as small as possible, such that even if the market moves against me and triggers my sell, the loss is minimized. And also, if I enter here and the market starts moving up, then at 61, it gives me a signal. I can add a position. So you enter small position, you enter 23.6 with a smaller lot, let's say like 0.5, expecting, just hoping, in case the market moves against me, it gives me an opportunity to enter at a good price, all right? Then you add position, maybe another 0.5 at 61.8, okay? So if now here the market reverses, it has given you a signal, now it is reversing, so it means now you are in a very good position, okay? But the moment the price reaches here now, you protect both of them. You can actually move your sell to your original entry, such that even if the price reverses, your original entry will give you 0, but your second entry will cover for that. right? Hope you got it. So the second entry, which you enter at 61, we call it averaging. Averaging. It helps you. Just in case you made a mistake in 23.6, you can actually get what we call a graceful exit. If the price comes here, you entered first at 23.6, price moved against you, around 61 gets you a signal, you enter another position, then the market comes here and it starts struggling. You can comfortably move the two as sells, okay, both of them here, such that if the market moves against you again, they are triggered, they are cancelled each other. You just come out at 0, you lose nothing. So we can always do averaging. But before you do averaging, just ensure you get a good signal. You can also add losses to a losing trade, okay? Don't always do averaging because you never know that the market is going to play out. It may actually be reversing. So you add to a loss to more losses, all right? But you can always do an averaging. But ideally in my rules, I don't enter any trade at retracement of 23.6 because the risk reward ratio is not worth it, right? Because you're taking that risk against a probability of maybe such kind of a profit. And we said that once in a while you can break a rule. But you can explain why am I breaking this rule? Because from my analysis, this market is very strong. The bears are so strong, it's a risk I'm willing to take. But you manage your risk by reducing the volume. Even right now, the size of lots, or the volume I'll enter here is not the same I'll use for when I enter at 61 or 78. 78, because the risk reward ratio is so small, I can actually, here, I can enter maybe 0.something, 0.2. If it gives me a chance here, I add. But if all this time it has not given me an opportunity, but it gives me a signal here at 78.6, now here I can actually take a bigger risk and enter at with a bigger volume because the risk reward ratio is pretty good, okay? Because if I entered here and my stop loss is here, that is the risk I'm taking for an opportunity to make that number of pips. So it means I can actually risk with because of the good risk reward ratio, okay? So hope you got that. Hope you got it. How to use Fibonacci ratios to decide where to enter, all right? So Fibonacci retracement is a very popular tool used by many technical traders to help identify strategic places for transactions to be placed, target price, that is TP, or stop loss. Now, you also use Fibonacci ratios for your TP. But for Fibonacci ratios, we use what we call extensions, Fibonacci extensions, okay? So you notice when after the 0, there are other ratios which are generated. We'll have one here, another one here. So they are actually outside the price action. They're outside. So this one will be 127.2. This is 138.2. This is 161.8. Can you see a similarity between that and my Fibonacci ratios? Can you see any similarity? 127.2, 138.2, 161.2. It's just like these numbers, you're adding 100, except for 23, This one you don't have 100, but we have 127 instead of the 23, you have 127. So when you are placing your trades, more often than not, you place your TP, or rather as per the rules, you put your TP at, first TP should be at 127. Your TP should be there, okay? So we use Fibonacci extensions for our TP, okay? But we compile with what we call the harmonics and structure. But you're going to see how we add all that together, But for now you can see we can already use the Fibonacci ratio to determine your TP, okay? So if your SL is here, and your entry is here, then we have our TP at 127.2. But if the price comes with a lot of force, you've entered, the price is coming, it's approaching, you can always move your TP from here to 138 as you lock profit, right? As you lock profit. Jackie also asked, how do you determine your break-even point? Also, at this level, when the price reaches, the price is around here, and you can actually move, if there is a very strong support here, and there are chances, let's see, where the 127 lies, maybe you have a very strong support. Here there's a very, very strong support. And from what it looks, the market is likely to reverse. You really don't have to wait for the market just here, okay? At just break even. You can move and lock in more profits and ensure you're closer to the market price as much as possible. So you keep on analyzing. You don't want to struggle your trade so much. You need to give it room to breathe. At the same time, where you see it's almost getting a point to reverse, you move your trailing stop a little bit more closer to the prevailing price to ensure you've locked as much profit as possible. So it depends on the structure of the market, how the price is moving and where it is approaching. Now that makes you it helps you decide, where am I going to place my trailing stop, or rather, where am I going to move my stop loss to try to lock in more profits. All right. So when you get to harmonics, that will tell you a little bit more. And harmonics tells us, should I mention it now? No, it's not necessary. Let's do one thing at a time, so that we'll get to know to take profit with time. But for now, we use the Fibonacci extensions to know where to place your TP. It can be 127.2 or at 138 as going down like that. But what happens also at this level, if the market has reversed, the deeper it reverses, the chances are our next low may not be very far from the previous one. So if this was our previous low, here we have our L1. At the market move to 61, chances are our L2 will be slightly just somewhere here. Okay? So the deeper it reverses, the shorter distance the L2 will like to be from L1. But if the market just reversed to 38 here and it started coming down, chances are our L2 is likely to be a little bit more deeper, maybe somewhere here. Our L2 will be there. So if it retraces much far deeper, it will also make a little bit a lower low, which is not further away from the previous low. Okay, but if the retracement is not so deep, but again, we'll go deeper into these details of the depth of the reversement. Yeah, but I'm just trying to give you some highlights to see how we also continue making use of the retracements and the Fibonacci tool to determine where to place your take profit. Because again, if the market retraced up to 61 and then you put your take profit here, my friend, it will take you long to be hit. You might even end up being taken out of the market. Yeah. So it's good to do proper analysis. If it is a deeper retracement, just take your take profit where it is appropriate. After all, don't look at, I want to make 100 pips. If the market does not have the strength to make 100 points, you cannot pull it down, you get. So you must go with whatever the market is telling you, all right? If it tells you it's likely to return here, just take your TP there. Even if you have 50 points, don't say, I must make 100 points today. The market, if it refuses, you will not force it, all right? So you have to comply with what the market is telling you. If it retraces deeper, the next low is likely to be just a few pips away from the previous low. So you have to be careful where you place your take profit. You can actually put maybe your TP here. You put your TP here and you entered here. Okay, let me show you. And I've suffered that. I'm telling you the things I've gone through. Okay, not by the way, where you say, I want to make 200 points today. So you enter there, all right? And the market, it's your base, your entry. Start moving in your favor, and it comes down. Your TP is here. Your TP is here, okay? It's there. So the market comes down, only for it to reverse here. Then it goes and takes you away at a stop loss. Is it worth it? Because you're saying market must come here, yeah? It must really give me 200 points. Can you miss your TP? Actually, there's a day I missed TP, I think by 2 pips, eh? And then from there, my profit was so much. I did not close at a loss, eh? But I gave back so much. Because when the market comes at this level, and then it takes you out at around here, you can imagine all this you've given back. Is it worth it? Because you felt you could not obey the rules. The market tells you the TP should be here, but you're like, no, me, I want 200 points. So you bring the TP here. So it has to be logical. What is the market telling me? The market tells me what it gets, it's like to struggle or to reverse. So I need to be careful where I place my TP, lest I give so much back to the market. You'd rather have your TP hit and the market continue moving down and down than the market almost hit your TP and reverse and you give back so much. Yeah? Yet it has already hit where it has indicated you it's going to hit and reverse. Are we together? So you share some of these experiences so that you don't fall a victim. But I'm sure you'll fall a victim before you learn these things. Eh? But it's good to let you know things don't always play out like that. Okay? So that's it about that. So the most significant Fibonacci retracement level to watch for is 0.618. That's the 61.8. Eh? That's a very key one. When I get a signal at that one is almost 80% expectation that the market will play out in my favor. As long as the market, the price has retraced there and it has given me a signal. Okay, so this is the inverse of the golden ratio. Remember we said between 50 and 61, that is our golden ratio. It's a golden ratio. The 0.618 retracement level tends to be the maximum pullback zone, where fear climaxes as the final sellers throw in the towel and the bargain hunters rush into the stock to resume the uptrend. On a downtrend, the 0.618 or 61.8% price level should be where the final buyers are exhausted as sellers take the opportunity to unload their positions and short sellers jump off the fence to push down the price and resume the downtrend. Some traders prefer to wait for 2 to 3 candlestick closes above or below a Fibonacci ratio level to confirm support or resistance before placing a trade. Remember, we are gonna we expect kind of a signal candle, or the market will signal to me this way that is about to resume. Then I'm able to enter. All right. There's something I wanted to say and sorry, something has escaped. I just hit and then it went. Maybe it's not necessary. So maybe I remember as we do the illustration. So that's the theory bit of it. So we are going to, I'm going to share my screen. We'll drop a few Fibonacci ratios. Then we see how it works. My phone is still not showing, so I'm sure people using the phone, they can't see yet, so I'm just waiting for it to load on my screen. But just before we continue, remember we said, when we came here, we said this market was already forming a warming, okay, double. We actually drew it, and for sure it has obeyed. It has broken the neckline, okay, it has broken the neckline and it's moving up. When we came in, it was about here on this candlestick here, okay? Sorry. It was on this candlestick here. But now we can see it has already broken and it's going up and up. So you can see these formulas and rulers, they mean what they say, rather what they communicate to us. But it doesn't mean they cannot fail. They can always fail. So you must put a stop loss there below the previous bottom or above the previous top. They can always fail. There's not, as we say, nothing guaranteed in the forex market. Not even to the biggest of the banks. No one is guaranteed of the profits. You only form an expectation and you see the probability of the market moving this way is higher than otherwise. Okay, so you move in that direction. Okay, so nothing is guaranteed. You only make your analysis, form an expectation, and trade based on your expectation. So I said for our trending market, I'm trying to look for a great. This is a good one. So when we look at this chart, that's our H1. Our H2, sorry, H2, that's our L1, and now we have one of the scenario I was definitely cited in the other side. That's our L2. So we said for a downtrending market, I'll try to just enlarge a bit. When I enlarge it becomes, it goes, but it's, I think I'm sure the people in front, they can still see that screen. For a downtrending market, when you're doing a Fibonacci, we draw from high to low. The market is going down, moving from high to low. So our Fibonacci will be from H1 to L1. So it's from the previous high to the next low. On the same line. So you got there's somewhere where it's written F. When you put first tells you draw Fibonacci retracement. So you just click on it, then you come place it on there, the high of your high, then you drag it down to the low. It automatically populates our percentages. As you can see, mine does not have a 38, it at 23 to start. I just remove the line because it does not communicate anything to me. And I don't want it to tell me to think now it's to enter. So to avoid the temptation, I removed it. Okay? So I'll wait for the market to hit 38 or 50 or 61. Any of those I can enter, right? Actually, if you see there's a signal that for this market retrace like this, all right, first let's see, it moved our H1, our L2. The market retraced to 50, all right? So maybe you meet and the market does not, you are not comfortable, you're like, before it reached 50, there was a very strong bullish candle, which is so scary, okay? That's why I was saying, volume means nothing. Volume can actually scare you. The size of the candlestick can scare you. And you can actually ignore a signal because of the size of the body, all right? There are moments the body makes sense in our analysis, but there are moments you just go. You don't put it into consideration. You look at the signal you're looking for is what you focus on, irrespective of that candlestick, okay? So here you can see this bullish candlestick was so strong, we have put that red arrow. It was so strong. So when the market hit 50 at H2, you can see where H2 is. It defeat the Fibonacci 50. With that candlestick, actually everybody will be so scared to end. But actually the market reversed. But the good thing it gave you a chance, all right? It went up again and it formed a moolah, all right? Because it's like at 50, there was first stop, and then at around 38 or between 50 and 38, a second, and the market moved down for me an L2, all right? But you see, the market is struggling. There's a lot of struggle. You can see there is small candlestick and also in between a bullish, bearish, bullish, bearish. So there's a lot of fight there, okay? No wonder our L2 is very different from our L1, okay? And because this is so, when the space is between the L1 and L2 is so strong, our net next, we expect a very deeper retracement, okay? When there is such a small difference between L1 and L2, so the retracement from L2 is going to be deep, quite deep. It has to be between 61 and 76, all right? So we're going to remove our Fibonacci. Let us move to draw the next one. So the next one will be from H2 to L2, right? So I pick my Fibonacci, I draw from H2 to L2, and true to my word, the market traced to 76. Yeah. So when you see this, the low, we said in a downtrending market, the lows get lower. But if the second lower is so, the difference is so negligible, so just a very few pips, we expect from L2, there is tracing like to be a little bit more deep. So when you see such a scenario, I will not enter the market unless it has given me a signal at 61 or 76. Yeah, because my expectation when the market plays out like that, it's for a deeper correction or a deeper retracement, right? So in such a case, the market retraced to 76.4, and then it started coming down again. So at that level, it formed another high. That's our H3, okay? Our H3. And then it formed a, sorry, not that one. It formed an L3. Now at this level, you notice the L3 is a little bit deeper. Let me remove the Fibonacci first to explain. This is our L1. This is our L2. And this is our L3. You can see the light blue lines, huh? The light blue lines are measuring the distance from one low to the next, okay? From one low to the next. You notice the difference between L1 to L2 is so small. Look at these lines. It is shorter than the distance between L2 to L3, okay? So when L1 to L3 is so small, so we expect a deeper correction from L2 to the next high, okay? And we achieved that. It went to 76.4%. But when now from L2 to L3, the distance is longer. The market is gaining momentum. So we expect a not so deep correction. It should not reach 70. It can still reach 61, but not be really deeper than, it should not be deep like the previous one, okay? So to confirm that, we'll draw our Fibonacci ratio, and the market moved to between 50 and 61. As opposed to the previous one, it moved to 76, all right? Also, when you're also drawing this, you don't use Fibonacci alone, you also incorporate support and resistance. Remember in our theory, where we read, it actually, these lines appear at lines of support. So when the ratio is in line with a support or resistance area, it means the market is likely to reverse there. Okay, and that's how we form an you wait for the market where we feel the market is likely to reverse here or to resume from this level. Okay, in our case, you can see this is a support zone. This is a support zone at around. Remember, it's a support zone. Let me just put a zone, a red zone. You see, there's a fight. There's a fight. Yeah. Based on this area here. Where is L2? You can see my L2. Those candles there, it was forming a very strong support. Okay. It formed support, the market went up. but it came with so much force. Just look at the candlestick, which broke that support. It had to be so strong to break support. So this support now plays as resistance, yeah, where the price is right now. Support is playing as resistance. So when the market was as L3 and we saw now it is retracing, we wait for the market at the next support, which now become the resistance. So if we get a signal where there is support or resistance, that signal is likely to, the market is likely to play out in our expectation, okay? So like somewhere like here, you can just enter your trade because the market is facing some resistance, yeah? But also the other things to incorporate, but you are actually bring them on board one so that at the end of the day, we incorporate all of them at once, all right? And then we can make informed decision. But you can see that was an area of support. It was broken now to be resistance as the market tries to break up, okay? It can be broken, it can also stand. It is to be broken, okay? So that's how we do a Fibonacci analysis. That's an uptrending market. Let me see if we can get any uptrending markets. But the principle is the same, eh? It doesn't matter. The principle is the same. Sorry. That was side. Which was the instrument? GBP, yes. I need to show you the entries here. Let me draw where you can see, yeah? This arrow is refusing. Okay. So now, let's say you came in, and then when you came to your chart, you found the price around here, okay? You can see there are very strong bearish candlesticks. At times you can actually be tempted to enter, feel like the market is leaving you out because of the fear of missing out. But if you find the market at that line, just let it go. It will reach somewhere and it will come back for you, okay? So the market comes and gets to our L2, right? You just wait for the market to play out for you to start planning, okay? The market comes and reaches L2, and you can see it starts retracing, okay? Then you draw a Fibonacci from H2 to L2, okay? So you can see where 27 is here. My 27 is here, right? This is now extension. It's not Fibonacci retrace, but it's an extension, okay? It's past the zero line, eh? So your TP should actually be at 127. Your TP should be there at 127. And you can actually see at this level, when the market got there, it's a little bit struggled. There were so many tails still coming. So if your TP is there and you already moved your stop loss to around here, then you can actually move it closer. You're like, hey, this one, I don't lose so much. Let me just move a little bit lower. Yeah, you get there. Okay. So the market struggles, you're lucky it doesn't knock you out, it comes down. You actually, when the market comes close, you can still adjust it. You move it a little bit further. But now you start bringing your stop loss closer and closer because the market can actually reverse at 127. Okay. So if you are lucky that it does not take you out, then the market comes to 138. You move your stop loss a little bit more. Yeah. You are trailing it, okay? Trailing slowly by slowly, all right? But sometimes, personally, what I try to do, depending on how the market is behaving, I trail at structure, right? Unless where the candlesticks are so long, yeah? And a structure means that the market retraced. I will just put it, because this will become a resistance level, I put my stop loss here. My stop loss here. It goes from another high, I bring my stop loss here. But if the market moves with such strong candles, I will actually draw a Fibonacci ratio And if from my analysis, the market, I don't expect a deeper correction, I will bring my stop loss to something like 61 because I'm expecting a shallow correction. So I'll bring it there. But if I'm expecting a deeper correction, I will not wait to lose so much. I will stop following my Fibonacci for a trailing. I start just locking as many as I can. So each market will just communicate to you how you can operate to match the way it is actually behaving. Okay. So if I'm expecting a shallow correction, I can move my trailing stop to either 50 or 61. But if I notice, like from L1 to L2, it was so clear from L2 I'll get a deeper correction. If I'm already in entry, I will not wait to lose so much. I will move my stop loss closer to L2, let it be taken out, then I can always enter the market again at H3, okay? So that way you win twice. You win twice in the sense that the first trade, you exited here at profit. The market moved up again, right? Then you entered, okay? So this distance here, you've made money twice on these pips here, on that distance, okay? So if you expect a deeper correction, you better just exit the trade, take your profit, let the market retrace, then you re-enter again, and you earn twice at that particular distance, all right? You earn twice on between that market price, sorry, between that range of prices. Hope it's making sense. Huh? Hope it's making sense. So any question, I think for Fibonacci we are done. So we have to look for a down uptrending market, but we don't seem to see it. Just look at that gold after this kangaroo tail. When you did that and you missed it, I just feel like, hey, where was I? You get. Also here there's a kangaroo tail. You can see this kangaroo tail there, and the market short all the way here. All right, kangaroo tail here, yeah, kangaroo tail here, and the market is still moving up. It's already more than 100 points. You're like, why am I not inside? But you never. Of course, there's a bad feeling, Don't beat yourself. Don't force it. Don't say it's already moving up. Let me buy very fast. It will reverse as though it has actually read your entry for it to run away from it. Okay, so don't chase price. It has left area of interest. Let it go. It will always give you another opportunity. Let it go. Okay, so I think that's it for today. Any question? Any question for uptrending? You just do the same. It's just that. Let's see if I can get to uptrending clear market. Yeah, just like this one here, okay? So this is uptrending, and we have our low there, and our high here. Then we draw a Fibonacci ratio, okay? Fibonacci ratio. So let's say in this case you entered, it came up to 76, yeah? So you see, it was coming so much force. The bears were so strong. Sometimes there's something the candles can also speak to you. When you get some successive bear candles without any bullish candle, then that one should also make you just think twice before you make a decision. Yeah. So, but let's assume just you bought here, okay? When the market starts moving up, it moves up to here, and you see it struggling. Yeah, some of the times I can actually, ideally, you should only move your stop loss or you have to break even if the market comes back to this level. It goes past this high. But if the market is here and you see it's likely to reverse. It is okay. Once in a while, break the rules. If you feel that it work in your favor, just move to break even. If it is just plus 5 points, take care of the commissions and spread. Okay, just to ensure you don't get out with a loss. So at times, just your own analysis and you realize this market may not be as expected, so you exit, or not exit, but you move to break even plus a few points. So that just gets it continues moving in bullish direction, you are safe. But in case it reverses, you're still safe. You're not going to lose so much. Okay, so that's a bullish. That's a Fibonacci tool on a bullish market. You draw from L to high, from down going up, because the market is going up. Okay. Again, I think we had actually identified this as a moolah. You see this? When you are doing the moolahs, we picked that and we said that's a moolah. Sorry, it's a WOMI, a double bottom with the second bottom a little bit higher. Okay, so if we enter, the market is still going up. You see, already moved up to this level. It has already broken it has broken the neck. Okay, so once it breaks the neck, let's say you entered around here, at this level here. Let's say you entered here. Then the market comes and reaches this line. It crosses the neckline here. So you can comfortably move your stop loss to break even. Always, if you get opportunity to protect your trade, protect. But again, don't struggle your trade so much. You know, you squeeze it so much you cannot even breathe, because it will take you out and then continue moving in your favor. Yeah. So once you see it has given up, when it reaches this level, it breaks the neck, or it breaks a high or a low, then you're comfortably good, because you know now the market it's already broken, and this is going to become a resistance. Because once it breaks, the market starts moving down. Yeah. Again, it is not supposed to go past here, because you expect to face some resistance here, some support here. Yeah. Because a resistance now it become a support. So I put my stop loss just somewhere below it. Yeah, saying when you come down there, you find some bulls waiting for you. So me, I just stay around here in case the bulls come and take me out. Yeah, but chances are the bulls should refuse to let you, and they should take the market back up. Okay, so now at this level, once the market, just a second. Some of these things are refusing to be highlighted. So you see like where the market is right now, it is somewhere here. So if it comes and crosses here, it goes past here, I will actually move my SL from here to this. This is it's a higher low. The market is uptrending. So once it crosses this line and I'm already in an entry, I will move my stop loss there. Because you're saying the market should not past here. If it goes past this line, where I've drawn my line that high, it should come and it should move from another high here. Okay, and if it is to retrace, it should not come past where my stop loss is. Right? So that's what I call by following trailing using structure. Yeah, I place on this low, then it forms a higher high, I move to the next low. But depending. But if the candles are so strong, I use Fibonacci ratios. But at the end of the day, you look at what really works well for me, what makes me more comfortable. We just use it. Right? Great. That's it. Any question on Fibonacci ratios or mullahs or WOMIs? How do you increase the range on the Fibonacci graph? What you do, great. Actually, I expected that. I don't know why I forgot to mention it. Once you draw, sorry, just a second. Like yours may not have extensions. I realize MT4 platforms, they really had tried earlier, because when you come to insert, you come to Fibonacci, it only has retracement and expansion. We don't use expansion. So it never has extension. We use extension, okay? So for MT4, all the brokers, I realize that's actually a problem. But the other system, which is the Ninja Trader, I use the Ninja Trader sometimes to do my analysis, that's already incorporated in it. but here you have to modify manually. Okay, so you just pick your retracement, you draw it, double click on it, right click, go to Fibonacci properties. Those ratios are here. All right, like if I want to add the 23 point something, I will go down. There is somewhere written add. I will click on add. It highlights. I will put 0.238. Is it 23.8 something? 238. Yeah. Then I write at the other side 23.8. Then I say okay. Okay. You see 23.8 has been added. Did you see that? Oh, sorry. Oh, sorry. I removed you from sharing. Oh, my goodness. Sorry about that. I forgot I took you back. I had stopped sharing. So let me see full screen. Let me share again. Sorry. Now I'm looking at my phone and I'm like, my phone is showing where I am. Sorry. I had stopped sharing to go back to the chat. So when you asked the question, I forgot to bring you back to screen sharing. Apologies about that. Apologies. So I'm taking you back to screen sharing. Can you see my screen now? My apologies for that. I forgot I'd actually stopped screen sharing. You can see it, my screen. So you are saying, remember what I had drawn earlier. When I was drawing my Fibonacci ratios, they didn't have. So when you are offline, I added 23 opening. I'm actually explaining it to you. So once you draw your Fibonacci, let me just remove it to do a fresh. Pick your Fibonacci tool, you draw it, yeah, then double click on it, right click, go to Fibonacci properties. It comes here. All right, it brings you that. So I already added 3.8, so I'm going to remove it. I will actually go down, click on it, and delete, and say okay. It has come out. To add it, I will double click, because most of the things you're going to add, like extensions. All right, click, go to Fibonacci properties, say add, then it highlights in blue to give me an opportunity to add what I want to add. Okay, so in this case I will add 0.238. okay, and a level. Then description, I will put 23.8. okay, then I say okay. Well, it has added 23.8. To add the extensions, mine is 127. So you do the same. So I can actually add, what don't I have? I have 138. I don't have 176. I just add that for purposes of showing you how to add extensions. You right click. After you highlight it, you are by double clicking until you see it has those, shows it has been activated. Okay, then you right click, pick Fibonacci properties, then you come, like for 161 you put 1.61, for 127 you put, I think I take a screen for you to add this, to show you how to add these extensions, so that you just know how to add those ones. But basically, under level, you put the 0 point something or the 1 point something. Yeah. Then description, you put the whole of it, the 127.2 and the 138. Okay. But before you do that, you have to click add. You click add, it gives you the blue line where you are supposed to type. You see that? Click add, this is the blue line, then you type there 0.2720.33. Then from there, description, you put now the 127 points, and then it will just pick automatically. You say okay, it picks automatically. My case, I want to delete what I've added. I don't like to use the 23.8. It can deceive me and tempt you to enter an entry, so I just delete it, and I say okay, it doesn't appear. I have a screen for all the extensions. I will look for it and share on WhatsApp. Then you can add the extensions. I know those ones are missing. They are never like automatic in an MT4 platform. All the brokers, not just this one. You always have to add personally. Okay. Great. So I will share that with you. But you can, now you know how to add. So I'll tell you I'll send you the ratios. The left on the description. Then now you add at your own time. Any other question before I move from the sharing? Any other question? Oh, wait, just give me a float. Sorry, from where? Please tell me. Tell me where you're floating, we go back. Or are you okay now? Are you sinking now? How do you increase the range on? Amma, this is the time you were in darkness. This time I was not sharing the screen. Tell me you got it now. Are we on the same page? Please confirm. Then I can repeat what you would like me to repeat. Can we ask any question which is not clear? Luther Kosawa. Jackie Marianne, please tell me. But I'm sure, you know, Luther was able to ask that because after the morning class, he was practicing. So he realized he cannot see what I think I will recap then ask. Exactly. Because for Luther, when he was drawing, he realized there is what he cannot see. You see, that's the essence of practicing. You are able to realize there is something I'm not connecting. So how do I connect it? So now you're able to ask questions, okay? Sounded about complex. Not really complex. Okay, you draw those Fibonacci ratios. Draw them, then you will be able to realize I'm not seeing what I was seeing in Prisca's chart. Oh, whatever she was talking about here, I cannot see it. Then be able to. By the way, it's not okay. Fibonacci ideally it's a little bit complex. Let me not lie to you. It took me time to internalize it, yeah. But when I move to price action, exactly. Please refresh but it's a bit. I agree with you. It's a little bit complicated. It took me time to internalize Fibonacci. Okay. So I had to read books, try to see what are they, even know where to draw from to where. It took me time, okay? So but until you practice, yeah, and you try to read those again, you're going to get. I'll also continue sharing the sorry, I'm not sending you the URL. I've not managed to send. I was telling the morning team, it took me time to prepare it, and I will share. It made me actually sleep at 1 a.m. So I want to make this other video later, then I will still be able to share for you too. But first, practice what we've already learned, what you've already captured. Try it. It gives you the momentum to try the next thing, right? And it also makes you to get questions to ask, right? Questions to ask. So please today, and you think you've not done your assignment. Only Maggie who did some assignment. Guys, find some time. I know you're busy in the office, but you cannot miss just 5 minutes. Some of them just require 5 to 10 minutes. Okay, even at home when you're waiting to join the class or before you sleep, I know you're very tired, you've had a busy day, but just try to do something so that you get to know what you're going to ask. You'll be able to know what I don't get this. You'll be able to ask. Yeah, but unless you practice to know what you don't know, it becomes difficult because you cannot ask what you don't even understand, and it becomes difficult to load more information to what is already not clear to you. Okay, but I agree with you, Fibonacci can be a bit complex. But as you practice, you're going to get it very well. All right? Please practice. At least Fibonacci draw for me. I think I have to make it as clear as possible. Downtrend, draw from high to low. Uptrend, draw from low to high. Okay? And I've shown you where it is. But ask any question you have. Don't suffer in silence. Ask, ask, ask. Even after this class, if we draw it, ask. We are going to show you until we are all on the same page. But I know Luther captured that because after the morning class, he was able to practice and he realized some things I'm not getting out to work them out. So it's until you practice, you're able to get to know where we need to some clarifications or to ask more questions. All right? Any other question? But when I learned Fibonacci, I realized I cannot do without it. It's so easy. But before then, I just read things, I read analysis, I'm like, what is all this? How do I do it? Yeah. But I had to take time, read more, practice more. But right now, I've given you the notes. You don't have to go and research again from Google, whatever. I've given you comprehensive some notes. We've explained here, and I'm also here to help you again through and through. You don't have to suffer in silence. It took me time. When I realized how important it is, how I can actually not do forex trading without it. Right? Do we have another question? Do we have any other question? Because learning Fibonacci will be very key before we go to our next question, our next topic. From Monday, we're doing harmonics. And harmonics go hand in hand with Fibonacci. Okay, that's why I try to arrange the classes in a certain order so that there is some flow. You get this, it prepares you for the next class. This prepares for the next class. Okay, that's why I'm going to write them in a certain flow. So please try. Okay, at least now you have between today. Tomorrow you can, the time for class, you can actually try to practice. So assignment you can submit by Monday because we don't have a class tomorrow. Is it from Monday to Thursday? Monday to Thursday. Over the weekend, the market will not be open. That's the problem. It will not be open. They will close at, but I don't know whether you can draw the patterns. The only thing I know you cannot, but I think patterns you can try. The only thing you cannot enter a trade, you cannot, yeah, they close schedule at 1 a.m. Tomorrow at 1 a.m. So you still have tomorrow evening. You can still try tomorrow evening. But I think you can draw the patterns or identify the patterns. The only thing you cannot do anything which is active in the market, like entering a trade, modifying stop loss, and when the market closes, you cannot do anything. But I'm sure you can you can identify the patterns and draw them. You can also Fibonacci. I think you can actually draw. I've never tried because when I know the market doesn't find anything on weekends. Yeah. So, but you can see if it can work on weekends, especially identify the pattern, capturing, and also drawing the Fibonacci. It should be able to work when the market is closed. All right. Just try. You never know. But I've never tried myself to look at on weekend. Friday closes, I close my everything and I go into my weekend. But just try. It could be working. Any other question? I pray that you panic and think this thing is now getting complicated. No. Fibonacci, I know, is one of the a little bit difficult thing, a little bit complicated. I've been fair. But it's so key. Once you learn it, it will be so lovely. You just enjoy doing it, drawing it and making those decisions based on the Fibonacci tool. Okay, so it should not scare you. It shouldn't make you fear Forex. No. So we are done, guys. Have a lovely weekend. We meet again on Monday in class, but WhatsApp's open. Let's ask questions. Let's do assignments. Let's chat there. Okay, have a nice weekend and good night. Thank you, Jack. We've got to crack it. There is no other way out. We've got to crack it. We are almost there. This small bump should not really make you feel like, things are getting tougher. This one, or maybe one of you can see is a little bit more tough, but the rest are